I'm gonna share with you guys today the 15 indisputable laws of stock investing. Everything that I have learned over the past 25 years through trials and errors, I'm gonna serve it to you on a silver plate. Like it's been said that a smart guy learns from his mistakes, but a wise guy learns from the mistakes of others. So I hope I got your attention. If you are interested in investing in individual stock, you are in the right place. And I applied those rules, and I obtained financial independence. Like I don't go to a job. Everything that I have accomplished, I accomplished through investments. And you can do it too. Now, you guys, you want to invest into individual stocks, and that is one of the best things that you can do for your future. But there are a few rules that you're going to have to abide by if you want to be successful at this. Rule number one: only invest what you can afford to lose. While this seems very simple, it is important that you invest only the amount of money that you can afford to lose into individual stocks. Guys, individual stocks are risky. Individual stocks are common stocks. I'm sure that you are going to buy a stock through your favorite broker, whether it is Fidelity, E-Trade, Schwab, and individual stock can lose up to 80, 90, or 100% of their face value. You are investing into a paper asset with a lot of liquidity. Individual stocks are the most liquid assets that exist out there. Now, if you were to buy BlackBerry, you would have lost the bulk of your money. If you would have bought General Motors, doesn't matter you are a big fan of General Motors, you would have lost the bulk of your money in 2009. Same thing applies to Lehman Brothers. And I can go on and on and on. The mere fact that you use the product and you like the product, it doesn't mean that the stock price is going to go up. So only invest individual stocks what you can afford to lose. Rule number two: have at least a 5-year time horizon. Now, I say 5 years. In the reality, you're better off having a much longer time horizon. I would recommend 10 to 15 years. And let time do all the heavy lifting for you. You see, it's not really about the price that you pay. or your entry point, even if that too comes into the equation. The most important thing is that you let time do the compounding. At first, it seems like you're not accomplishing anything. At first, it's almost like an offense, like the dividends that you receive. It's almost like very negligible. But then, year after year, decade after decade, the compound is going to do all the work for you. Like I believe Einstein said, compounding is the eighth wonder of the universe. So take advantage of that. Also, the other reason why you should always have a long time horizon, you are going to profit much more if you have 10, 15, 20 years time horizon compared to entering and exiting the market. Entering and exiting, because every time that you buy and sell, there is always going to be the human error involved in it, like what to buy, when to buy, how much to buy, and then when you sell, what to sell, when to sell, how much to sell. You see, there are a lot of decisions involved with it, and every decision is gonna take some risks. So time horizon, it is very, very, very important. There was a survey done by Fidelity, if I remember well, and they found out that the best performing brokerage accounts were of dead people. So it is important that you are not gonna touch your brokerage account for a very long time. Also, like Warren Buffett put it, his favorite holding period is forever. And if it comes straight from the mouth of one of the most successful investors in history, well, then I would pay attention to what he has to say. Rule number 3, always DCA into a position. What does it mean? Once you make the decision to enter a position, like there is a stock you like, you have done all your due diligence, and you want to open a position in that security, always DCA. I personally always prefer DCA into a security rather than buying by a lump sum. The thing is that me personally, I am not a good market timer. It's not easy to time the market. It is all also being said, timing the market beats timing the market. And the reality is that it's not easy to pick the bottom. And really, no one can pick it for you. But what you can do, you can DCA, dollar cost averaging, into a position in a way that you are going to buy that security around the bottom. Possibly you're going to buy at the bottom, but because it can always go down further, well, then you are going to buy at all prices. When the stock price goes down, you're going to buy more shares of it. The other thing, too, is that when the stock price goes down, your dividend yield goes up. So always DCA into position. You are going to come up with an amount of dollar amount, whatever you can afford, and you are going to spread out your buys over the next, I would say, 3 to 4 months. I usually spread it out over, I would say, over 6 months. But, depends on your budget, your decisions. It's always better to DCA into position than buying into with a lump sum. Rule number 4, never buy a stock that has been trending down. You see, also, like it's been said on Wall Street, never catch a fallen knife. Those are value traps, guys. And I can mention many, many examples of stocks that came down a lot. And while it can be a good opportunity on paper, not always is gonna pan out. Right now, there are a few stocks. One of them that comes to mind is Nike. Those are great companies, but by the time they restructure the company and gain the confidence of the investors back, it might take a very long time. And I don't think that you want to keep your money tied up in that position. The other one, PayPal. Great company, great fundamentals. There's nothing wrong with the company, but the stock has been trending down a lot. Also, Adobe, the other one that is really a good company with great fundamentals. I believe Adobe got caught up into the SaaS apocalypse, which many of those software stocks got obliterated because of everything that was going on with AI. Regardless, I believe that you want to stay away from those stocks. The other thing too is that while there are a lot of software stocks now, and at the time of this recording, May 2026, see, the stock market is at the all-time highs. Like S&P 500 is flirting with the all-time highs, same as Nasdaq. I wouldn't buy individual stock, even if it does appear being a value stock that has been trending down a lot while the broad market is at an all-time highs. I wouldn't do that. I believe you're gonna be holding the bag for a very long time if you buy into a stock that has been trending down, because no one really knows when the restructure is going to take place, and no one really knows how long restructuring is going to take. So for me, it's a red flag. Now, of course, if you already own one of those stocks, I would hold on to those. But regardless, I wouldn't start a new position into a stock that has been trending down for months or even for years. I would let it alone. Number 5, never buy a stock that has gone way up. If the stock price chart looks like a hockey stick, while it might be very tempting to buy a stock like that, I would stay away. You want to do the opposite of what the crowds do. If you invest like the average investor, well, then you are going to get average results. You want to do the opposite. Now, also, there is a saying, again, from Warren Buffett that says, be greedy when others are fearful, and be fearful when others are greedy. If a stock price has gone up in price a lot, that means that there is a lot of demand for that. All the stock price is supply demand. Supply demand. And when there is a lot of demand, you are going to get average result. If you behave like the crowd, you are gonna get the crowd result. And it's not very good. A couple of stocks that come to mind now are LITE, light, which is momentum, SNDK, which is SanDisk. Guys, those stocks have been skyrocketing over the past 4 to 6 months. And you want to stay away from those. I know that the temptation of getting into those securities is high, but sooner or later, see, those stocks, they can't keep growing the way they have been. It's just mathematics. Sooner or later, the crowd is gonna sell by the bulk, and I am 100% sure that you're gonna be left holding the bag on those positions. So now, everything that is going on with AI, there is a lot of euphoria. People don't even care what the stock price is. They just want to get in. Same thing happened in the 70s with the Nifty 50s. And this is something that Howard Marks always mentioned.
Of Hewlett Packard, Perkin-Elmer, Texas Instruments, Merck, Lilly, Xerox, IBM, Kodak, Polaroid, AIG, Coca-Cola, and Procter & Gamble. And if you bought them all in 68 and you held them until 73, you lost 90% of your money. Why? Because they were overpriced. The average stock since the post-war has traded at 16 times its next year's earnings. These were trading at 80 and 90 times. Why? Because they were so good. Everybody says, these are great companies, nothing can go wrong, so it doesn't matter what price you pay. And if you pay 80 or 90 times, that's fine. So here we are.
Those were the top 50 companies in US economy in the 1970s. And you couldn't pay too much for those companies. It doesn't matter the price. And sure enough, you would have bought the Nifty 50, you would have lost 70, 80, 90% of your money, or possibly more as of today. So stay away from those companies. It's as easy as that. When you buy those companies at a hefty multiple, whether it's a PE ratio, price to free cash flow ratio, you're going to put yourself in a bind where sooner or later those companies are going to go back trading to the real PE ratio. It could be 15, 20, 25, 30. And if you buy those companies at 40, 50, 60 PE ratio, 60, 70, 70 price to free cash flow ratio, sooner or later, even if the company grows a lot, they need to 3x, 4x, 5x their profit, well, their cash flow, in order to make sense of those price multiples that you paid when you bought that security. And in my life, and I have enough evidence to say that for a company to grow their profit 30, 40, 50% for years to come, it's basically impossible. Now, of course, everyone now wants to get into the hottest stocks in the AI sector. It is what makes sense the most. But also, I remember reading a book. I believe it was a book from Peter Lynch. And one of the things that he recommended was stay away from the hottest stock in the hottest sector. Rule number 6, always buy a stock on fundamentals. What is fundamentals? Fundamentals are income statement, cash flow statement, and balance sheet. It might be easier to buy a stock on technicals. There are a lot of people who buy stocks on technicals. Like they draw a lot of lines, they see there is a channel, and they buy stocks at the bottom of the channel. But guys, 60% of the times, it works all the times. It's not enough for me to put my money into a security based on technicals. Also, because millions and millions of traders and investors, they are looking at the same charts. And even here, I want to make a distinguish between a trader and an investor. I'm talking to you, an investor. What is the difference between a trader and an investor? Time. A trader can buy a stock at 11 in the morning and sell it at 12 noon. That's your trade right there. A daily trader, by definition, should close his positions by 4 p.m. or by 8 p.m. on that day, if they sell it after hours. But I'm talking to an investor. And usually, an investor, what makes the difference between an investor and a trader? It is just the length of time that they hold their positions. Okay. I can make money as an investor. Trading, me personally, I do trading. I do have several accounts where I invest money for the majority and I trade money, but I am definitely not a day trader. I am more of a swing trader. So again, always buy a stock on fundamentals. I would study that company real close. I would watch all the most recent interviews with the CEO. I would study everything which is available, which is public record. I would ask AI always, because AI always have has the most updated information on that company, and I would focus on positive EPS, earnings per share, and growing sales over the past 5 years. I would focus on net income, how much net income they clear off of their total revenue, how much cash they got in the bank, what is the long-term debt of that company, is it sustainable, what is the free cash flow of that company, and what it has been. So you know what I'm talking about. Do your homework before putting $1 into a security. Make sure to do all of your due diligence. And again, it comes to mind another quote from Warren Buffett where it says, if you are not willing to hold a stock for 10 years, don't even think about holding it for 10 minutes. And this is really one of the best suggestions that anyone can give you. Rule number 7, don't overpay. Going back at what I was saying, always before buying an individual stock, take the temperature of the stock market. In other words, S&P 500 moves in cycles. Where are we now in the cycle? While it's not easy to decide when is the bottom, what is the bottom, because it can always go down further. Or is this the top? How high can it really go? Because it always seems that when the stock market is overpriced, it's gonna get more overpriced, and more overpriced. So I don't even want to use the word overpriced. I would use the word high priced. Okay, I can give you countless examples of people buying at the top of the market individual stocks, and they were left holding the bags for a very, very long time. I can give you the example of Cisco system. You would have bought Cisco system at the highs of the Nasdaq in year 2000. It would have taken you 26 years, 26 years to go back to zero. Those stocks can go sideways for a very, very long time, and they can drop and they can stay down for a very, very long time. And now Cisco has possibly 20, 30 times the revenue they had in year 2000. Net profit has been growing steadily for Cisco system. So you would have bought Cisco in 2026, you would have been underwater for a good 25 to 26 years. Not a bad feeling. I wouldn't wish that to nobody. And there are countless examples like that. Even Microsoft went sideways for a very long time. If I'm not mistaken, Microsoft went sideways for a lot of 10 straight years. I believe that then when they replaced the CEO with Satya Nadella, that was when Microsoft the stock price went back up again. But it might take a long time. That's why I always suggest to my audience to invest early. The earlier you invest, the better. Because when you buy a stock, it might do nothing for a very long time. So if you can take those years out while you're young, sooner or later a stock is gonna go up if you invest in the right companies. So again, do not overpay. Always pay attention to the multiples. And you can use a stock screener. There are a few free ones on the internet. One of them that I use is Fenwiz, no affiliation. The other one, I believe, macrotrends.net. They got a good one, but you can find those online everywhere. Just pick the one that you like, the interface better, and stick with it. But I always invest using a stock screener to come up with the right stocks. And you might, of course, have your own criteria to invest, like net income or a minimum percentage of ROI. Eventually, you're going to have to make your own rules, and you can research the stocks you like. And every quarter, I would repeat the same research and see if there are more companies that meet your criteria. This also depends on the sector that you are going to invest. Like right now, if you invest in semiconductor companies, of course, the PE might be more elevated than if you invest in an insurance company. Of course, that too depends on the sector. And I always recommend that you stick to what you know. There was the famous concept of the circle of competence. Once you define what your circle of competence is, you stay within your circle of competence. Rule number 9, pay attention to the percentage of that company which is owned by insiders. You ever thought of that? Like if it is a very small cap, you buying, you might want to make sure that they have some skin in the game. This is a very important point, and I believe that most traders, investors, they overlook this point. I usually use marketbeat.com and no affiliation, where it says the percentage of that company which is owned by institutions and the percentage of that company which is owned by insiders. I believe that for a mid cap, you might want to see at least 10% owned by insiders. And for a large cap, about 1% owned by insiders. Number 10, insider trading. Pay attention to what the insiders are doing. If the insiders are selling by the bulk, I don't think it's a good buy. I wouldn't buy a company because I like their product or because I like the fundamentals if insiders have been selling by the bulk recently. I am not privy to insider information. See, while insiders do, of course, and if I see a heavy selling by insiders, it's possibly because they know something that you don't. There can be many reasons. They are going to get ready to issue more shares, or they're not confident on next quarter earnings. An insider can sell for many reasons. Not all are bad reasons. An insider can sell because they need the money, or they need to invest, or they need to take care of their own personal expenses. There are all legitimate reasons why an insider can sell, but I would say that in the majority of cases, insiders sell because something is wrong with the company. If they are not selling because it is part of a pre-approved plan, that too happens to where they decide ahead of time that they are going to sell X amount of share by that amount of time frame, or it can be like a date, within a year or within 2 years. There is already a pre-approved plan from the board that they're going to be selling those shares. I wouldn't buy a stock if I see a recent insider selling, possibly because they know that the stock is fully priced, of course. Now, anything can happen. That stock might be heavily shorted. So if the stock price goes up, it keeps going up and up and up and up. But that's only because the short covering their position. But again, pay attention to what insiders are doing, and you can find that information online through many sites. Number 11, buy a company with a moat around it. And a moat is going to give that company a durable competitive advantage. And this is something that you can rely on, something that you really need for your investment to be successful in the long haul. I usually invest in very monopolistic companies. It doesn't have to be a monopoly. To find a monopoly now with the antitrust regulation is not easy, but at least a duopoly, you can invest in duopolies. There are a lot of duopolistic companies out there. Also invest in company that have a exclusivity. It can be a territorial exclusivity. And the first ones that come to mind are utilities, okay? Like PCG, which is PG&E. They have the exclusivity for Northern and Central California. It wouldn't be easy for another company to go there and replace all the equipment, all the pipes, the cables, the infrastructure. It wouldn't be practical for a company to undertake that territorial exclusivity. Okay, other companies that they have a moat, of course, comes to mind Live Nation, even with the recent antitrust lawsuit. But you know, of course, Live Nation and Ticketmaster, they have basically monopoly, and for the tickets, it's basically the only one place where you can get tickets for an event, and they own the arenas where see a lot of performers. They can only perform in those arenas for security reasons, etc. So for me, that is a monopoly. Now, I'm not suggesting that you buy Live Nation or any of those companies tomorrow, but I'm only giving you a few examples where you can make money if you are willing to hold the stocks for a very long time, given the nature of the business. Of course, Coca-Cola, because they have pricing power. If a company owns a monopoly, has pricing power, and how many times you've seen a replica of the Coca-Cola? They got the every store they have their private label cola, and if consumers are willing to pay extra to buy Coca-Cola, that is true pricing power. I believe once Costco tried to get rid of Coca-Cola, and eventually they went back selling Coca-Cola because people were willing to pay additional to buy the Coca-Cola brand. It's not only a drink, it's a state of mind. Other companies that come to mind that have good pricing power and they run it like a monopoly. EssilorLuxottica, ticker symbol ESLOY, ESLOY. And of course, they have, I believe, at least 90% of all the sunglasses, everything which is lens, sunglass, market share is huge, and it is a monopoly. Every time there is a new sunglass company out there, they either are gonna put it out of business or they're gonna buy it outright. And now with everything that is going on with smart glasses, I believe Meta, they signed a multi-year deal with Essel or Luxottica. Of course, they own all of those brands. Basically, they are the only game in town. Other companies, of course, I believe that Google has got a huge moat around. When it comes to semiconductor, I do believe the ASML, they have a great technology that is not going to be easy for anyone to overtake. And TSMC, I believe Taiwan Semiconductor possibly has the widest moat because all of those chips companies, they have to use Taiwan Semiconductors to make their chips. Possibly because Taiwan Semi has the technology to make those chips at a very affordable price. It wouldn't be easy to replicate for any other company that wants to be virtually integrated. Like again, Monopoly, TDG, Transdime. This is a company that they sell parts and pieces for aerospace, for all of those commercial airplanes, not only commercial, it can be private, it can be military. And I believe that they have a long-term deal. They have long-term contracts with all of those airlines, and it's not gonna be easy for any other company to undertake them or undercut their prices while the validation process in order for an airline to switch a supplier is very lengthy and pricey. They also have government with the Defense Department, the government, the aerospace. They are really grandfathered in, and it's not going to be easy for anyone to create a problem to TDG. The only thing with TDG is that they use leverage to secure those contracts and to buy out their rivals. Like if there was to be a smaller company, a smaller aerospace company, eventually they are going to take on a lot of debt. Sometimes they issue shares, or sometimes they uh, pay a special dividend in order to get more investors to buy into their company. But regardless, I believe that TDG has a huge moat around it. And for the cosmetics industry, I like L'Oreal more than anything else. I do believe, while it is not a monopoly, I believe that they have a huge market share, and they like L'Oreal a lot over in China. And it's not easy for a Western company to make its way into the Chinese market. I believe Chinese market is appealing to all of those companies, but it's not really easy. Not even Google is there. None of those social media companies are there. They want to make their own stuff. So if you can invest in a company that is highly appreciated in China, being over 1 billion people, there are not many companies. Companies that come to mind mind that operate in China: Microsoft, Starbucks, Nike, L'Oreal. So if you find one of those, I think it's a good opportunity if they are really appreciated in China. And like a duopoly, there are a few duopolies. I feel very comfortable investing my money. Of course, one that comes to mind is Visa and MasterCard. I like them both. MasterCard has more of international exposure, and they are willing to take more risks and work with international banks, while I believe Visa is a slower grower, more conservative. But of course, Visa has a slightly better fundamentals. I believe, growth, you are possibly better off buying MasterCard if you can get it on a dip and hold it for a very long time. I feel comfortable with both. Other one that comes to mind, Lowe's and Home Depot. Now, while I don't invest in neither of those because I'm not really a big fan of the sector, the other one is Boeing, Airbus. They are a duopoly. Of course, like everyone knows, I don't invest in those either, but it can be a good opportunity for you guys if you understand the sector. Rule number 12 for investing in individual stock. It might appear counterintuitive, but diversify into other asset classes. Guys, like Ray Dalio always says, it doesn't matter in what asset class you are in, sooner or later, that asset class is going to drop 50 to 70%. This is what history teaches us. And if you are a real estate guy, if you are a crypto guy, you are a stock guy, if you are a stock guy, like every other asset class, sooner or later, being a common stock, an asset class, sooner or later, it's going to experience a 50 to 70% drop. Now, even if this is a video related to individual stock investing, I always recommend to you guys to diversify. Never put all your eggs in one basket. Concentration builds wealth, but diversification helps to preserve it. So it is important that you invest in other things. Now, you might have the majority of your portfolio in individual stocks, but I recommend that you invest. Like again, Ray Dalio said, you might want to find 8 to 12 uncorrelated assets. In a way, if something was to happen to one asset class, well, then you're going to be okay. It is a very smart thing to do. Of course, we all know that Jeff Bezos, Mark Zuckerberg, etc., they got wealthy with one idea that is true. But I would recommend for an investor, a retail investor, to have money in other asset classes. Rule number 13, and again, this too might be counterintuitive. Always have an emergency fund that you don't touch. You don't buy stocks with it. You don't buy assets with it. You have an emergency fund for anything that can come up in your life. This is like an insurance policy. It is something that you have to have, and the hope that you never have the need. Okay. But going back to what I was saying earlier, then stocks can go down, it can stay down, they can go sideways, and they keep going sideways for a very long time. Let's say that you need the money now. What can you do? You can sell your stock at a loss because you have an emergency or you have an expense that you didn't budget for it, or you can tap into your emergency fund. It is always better tapping in your emergency fund, of course, so that you don't have to sell your position, much less you want to sell your stocks at a loss. So always, you want to invest in individual stocks, you always have to have emergency funds. Do not forget. Number 14, rule number 14, and this too is related to the other two. Me personally, I have 10 to 20% of my portfolio, depending on market conditions, in treasury bills. Guys, treasury bill ETF is your best friend because your money is there ready to be deployed when you need it. Treasury bills don't fluctuate a lot in price, they stay pretty flat. Now, of course, anything can change. Something was to happen with the Fed changing rates, that's going to get into your dividend yield. If the Fed was to drop rate, your dividend yield is going to drop too. But I believe that the Fed has no choice but to raise rates. Okay, with everything that's going on right now, oil price, sticky inflation. While the Fed is going to have to raise rates sooner or later, your dividend yield is going to go up. When there is a stock market correction, a lot of people are going to flock into safer asset or safe havens, and treasury bills is your friend. Your principal is going to go up, and you're going to have the dry powder ready to deploy while everyone is panicking. Of course, you are gonna have the chance to buy your favorite stock at your favorite price. Guys, treasury bills, at least 10% of your portfolio, if not 20. Rule number 15, make your own plan and stick to it. Stay the course. The most important thing is stay the course, even when market volatility makes it tough. And again, this is related to one of the best quotes from Warren Buffett. And it says, rule number one, never lose money. Rule number two, never forget rule number one. You gotta make your own rules and you have got to stick with them. Never break your own rules. Never sell at a loss. Never take your money at a loss to invest in another security. If you were wrong with the first security, how is it that now you're going to sell at a loss and put it into a different security? Don't do that. Like Einstein put it, you can't solve a problem with the same mind that created it. So, guys, make your plan, stick to the plan even when the going gets tough. And when the going gets tough, the tough gets going. Okay. Also, there is another quote, I believe, from Abraham Lincoln that say, "If I had an hour to cut a tree, I would spend 50 minutes to sharp the blade." So those are the 15 rules. Apply them and you are going to be successful investing in individual stock. Feel free to reach out comments, questions. I'm here for you guys.